going on, guys? Luke here from LAGFX. We're back today with another video. If you're new to the Learn to Trade series, we basically cover topics that are going to allow you guys to learn to trade and hopefully become profitable, competent traders in the forex world. We are currently going through a series at the moment. I'd like to say it's going to be a 8-part series, but I could be wrong. It may be more, maybe less. It just depends on how quickly we cover the topics, whilst obviously retaining you guys throughout the duration of these videos. In today's topic, we are going to be talking about risk management and the risk management strategies that we should be putting in place when it comes to creating a comprehensive trading plan. So there are 3 things that we look at when we look at risk management. 1, how much we are going to be risking in the positions that we are placing. Secondly, where are we placing our stop loss and take profit orders? And the 3rd thing is, how are we managing running positions? These all fall under the line of risk management. So we're going to be covering those topics today. So I'm going to be telling you guys how much I risk per trade that I place. We'll also be going over the things that I integrate and implement when it comes to managing a running position. And then we're going to end on where I look to place my stop loss and take profit orders. So by the end of this video, you guys should have a great understanding on risk management itself within Forex. And you should be able to take this information away and actually go ahead and create your own risk management strategy within your trading plan. Now, the videos that I've been creating and that I'm going on to create within this series is here for a reason, because I want you guys to take this information away with you and adjust it to your needs, your lifestyle, your needs, the type of trader that you are and the type of trader that you want to be. I'm obviously explaining the things that I integrate within my lifestyle and my trading plan, but it doesn't necessarily mean that you need to follow that identically. There are going to be things that you do differently, and there are going to be different things that you implement within your trading plan. But one thing that you should always do, and you should always ensure that you are doing, is to, once you have created your trading plan, stick to it. There is nothing worse than creating a trading plan that is completely tailored to you as a person, and then you go off course and begin to unfollow the trading plan that you've set for yourself. That is going to have a negative impact on your mental state as well as your success in the forex markets. Now, I don't imagine this video being too long, especially not as long as the second episode, but the information I'm going to be going over is very, very important. So make sure that you stick around throughout the entire video. If you do go on to enjoy it and you learn a thing or two, don't forget to leave a like on the video. And if you're new around here, don't forget to subscribe and click that notification bell. Now, the first thing that we're going to be touching base on is risk tolerance. This is basically how much we are going to be risking for every trade that we place. I risk 2% of my equity, and this is because of the success rate that I have with the strategy that I implement. Now, I would never recommend to anyone to risk more than 2% of your equity. Why? Because when you are risking more than 2% of your equity, depending on how much of a drawdown you go into, this could lead to substantial loss. By having a 2% risk, you could take 50 consecutive losses before actually blowing your entire equity. With a 1% risk, it would take 100 trades to go in the wrong direction and to hit stop loss in order to blow your account. So when it comes to setting your risk tolerance, you should take those things into account. How many trades am I likely to take a loss on before actually taking a win? Now, with a success rate of 70%, like myself, 7 out of 10 trades should realistically be winners. But if we look at this in a bigger picture, so let's say that we placed 50 positions, realistically with a 70% win rate, 35 of those should be winners and 15 should be losers. But what we have to take into consideration is it's not going to be 7 wins, 3 losses, 7 wins, 3 losses. It could be the full 15 losses before we then go ahead and have the 35 wins. It could be laid out very differently. So let's say that you had a 50% win rate. So out of 50 trades, 25 are going to win, 25 are going to lose. Now, not every time is there going to be, I don't know, 5 wins followed by 5 losses, you may have the full 25 losses before you then have the 25 wins. So this is something we need to take into account, and this is just part of trading. So when it comes to that risk tolerance, this goes back to my first point. If you had a risk tolerance of 3% and you're taking 25 losses consecutively, you are losing 75% of your equity before you start winning. That is going to put you in a major drawdown before you see any kind of profits in the markets. So when it comes to your risk tolerance, as I said to you guys earlier, never risk more than 2% of your equity. When you're placing these positions, you should be placing them at least a 1 to 2 risk to reward ratio. So if you are risking 2%, you should at least be looking to gain back 4% from the position, which is why integrating risk to reward ratios followed by a strict risk tolerance is going to increase your profitability over a long period of time. So as I've said, I would never recommend risking more than 2%. I risk 2% personally. I would suggest to new starters, people that are still on the road to being consistent, just stick to 1%, even 0.5%, and you're not going to see too much of a pinch from your equity when it comes to taking those losses. As you see consistency within your strategy and you have plenty of data to fall back on to suggest that you do have a win rate higher than 50%, then yeah, there is no harm in looking at integrating a higher risk, 1.5%, 2% per trade. But for anyone who's new starting out, I would only ever suggest risking 0.5 or 1% of your equity per trade. Now, there are formulas online that you can use. I will put a formula on screen of what I integrate when it comes to Great British Pound and US dollar pairs. But as I say, there are actual formulas and calculators online to find your lot sizes when it comes to placing your positions. Okay, so the next thing that we're going to touch base on is stop loss and take profit orders. So what we're going to do is we're going to load up a chart. And what we're going to do is we're going to touch base on my strategy ever so slightly and where I would look to place my stop loss orders and take profit orders and my reasoning behind them. And this should help you guys figure out where you should be placing your stop loss and take profit orders based on the analysis that you guys perform. We have what looks to be a bullish trend at the moment. Okay. Now, if we were looking to get involved in this last impulsive wave that's just taken place, we obviously want to be looking to get involved in this market in buy positions, as this is the direction of the market. Now, when it comes to placing our buy positions, we want to try and get involved at the start of the impulsive wave. We don't want to be getting involved midway through, as we're not going to get a good enough risk-reward ratio. And we don't want to be getting involved towards the end either. So we want to try and get involved as closely as possible to the new bullish trend that's being put in so we can take full advantage of the entire swing. Now, when it comes to placing our stop loss, where do you think that we should place our stop loss? Do we place it below this low here? Do we place it below this low here? This low down here? Or do we place it below this low? Well, for me personally, I would be placing my stop loss below this low. The reason being is because if price continues to trade below this low, that should be seen as protected, then I no longer want to be in the trade. Why do I no longer want to be in the trade? Well, if price decides to, as I say, trade down as it has done, trade up, and then trade down, this is still following the laws of bearish structure, where we break the lows and we protect the highs. And I therefore don't want to be in this trade anyway, because this tells me that price should continue trading us in a bearish way. So the sooner we get out, the better. So as soon as I have confirmation that price is trading against me and the analysis I've put in, I don't want to be in on the position anyways. So by setting our stop loss just below what should be a protected low, that we aren't staying involved in a market that's going to be trading against us, because as we know in bullish structure, we protect the lows and we break the highs to create new higher highs. So this low should be protected to create a new higher high. What should follow is a higher low and a higher high. Okay, so that's just a simple look on price action, a simple look on the laws of structure. But I would essentially set my stop loss in a bullish position just below the last protected high, and if it was in a bearish position, so if we look here, I would place my stop loss just below the last high. Why? Because that should be protected in the eyes of bearish structure. Now, when it comes to placing a take profit, so if we just go back to this bullish example, I want to be setting my take profit just below, in a bullish position, just below the last high. Why do I want to do that? Well, if we go back to our analogy and our thought process when it comes to bullish structure, what we see is we see higher highs and higher lows, where the highs break to create a new high, and we protect the lows, right? So this high, in theory, should break to create a new high, right? So price should trade up here before pulling back, essentially. So by setting our take profit just below this point, this guarantees that our take profit is achievable. If, however, we set our take profit just above, maybe here, what we may find is price comes to trade up, doesn't quite hit take profit, but reverses before then going higher. So that is actually going to lead to emotional decisions being made, and this could mess with our psychology when we're looking at placing positions, because we may see price pull back and price trade lower towards our entry point, and it may mean that we actually miss out on substantial profits. So by setting our take profit just below the last high, that in theory should break to create a new higher high, this guarantees that our take profit can be achieved. Now let's look at this in a bearish way. So in bearish structure, we have the production of lower highs and lower lows, where the lows break to create a new low every single time, right? So again, what should we do? Well, if we look to get involved in a bearish position, in a bearish market, we should set our stop loss just above the last protected high, as the highs are protected, to create a new lower high, and our take profit should be set just above the last lower low. As you can imagine, if we want to see price create a new lower low, we can expect this low here to break to go on to create that new lower low, right? So by setting our take profit just above this, it guarantees that our take profit can be achieved. And you'll notice that if we follow this strategy and if we follow this way of thinking, our probability of being successful is going to increase exponentially. On top of that, you are going to see that our risk to reward ratios are only positive, because we are refining our stop loss and we are stretching our take profit so far that we are still within the midst of guaranteeing a take profit hit. So that is my outlook on where we should be placing our stop loss and take profit orders. So there's a few notes that I'm going to make here. There are 5 points to take away there just from the 2 things that we've been over. Risk no more than 1 or 2% of your equity per trade. There is formulas online, and I'm also going to give you guys a formula. What I'll do is actually leave it in the description of this video. And then in terms of our stop loss and take profits, when we are placing our stop losses in a bearish market, place our stop loss above the last protected high. In a bullish market, place our stop loss below the last protected high. When it comes to our take profits, place your take profit in a bearish market above the last protected low. And then in terms of a bullish market, place your take profit below the last protected high, as this is almost going to guarantee that our take profit can be achieved. So those are just 5 pointers to take away from what we've discussed already. And I've gone over the reasoning as to why it's so important. Now, the last thing to touch base on and the last thing to go over is how we should be managing the trades that we are placing. So what I'm going to do is I'm going to show you some examples of how I would manage the positions I place and my analogy behind them and the reasons behind them. So if we just head back over to the Euro US dollar market. Okay, so if we just get our position, place our stop loss just below the last protected low, because it's a bullish position. We place our take profit just below the last high, as this guarantees our take profit can be achieved. As you can see, our take profit would have been achieved. Now, when it comes to managing this trade, how would I have gone about managing this position? Well, when this trade is in 3 RR worth of profit, what I would have done is I would have taken a 50% partial. So if I'm risking 1% of my equity, when price is at 3 RR, okay, that means that it's at 3%. So it's at 3 times whatever I'm risking. So it's at 3% profit, okay? Now, if I take a 50% partial, if I take 50% away from this trade at 3 RR, how much am I taking home with me? Well, I'm banking 1.5% from this position, right? Because I've taken 50% at 3 RR. So half of 3% is 1.5. Now, worst case scenario, the trade then reverses and hits stop loss, yeah? I only have 0.5% left of this position running. Why? Because I took a 50% partial. I took a 50% partial earlier on a 1% trade. So I've only got 0.5% running. So if stop loss was to hit, I still walk away with 1%. Because I took a 0.5 loss, but we banked 1.5 earlier on, right? Now, let's say that we implement a SL move. So we decide to move our stop loss to entry. Well, that guarantees that we then walk away with 1.5%. Because when price then trades us down and reverses, it actually hits our entry point and closes us out the position. So we therefore lose nothing from the trade. So we walk away with 1.5%. Now, let's say best case scenario, this trade then goes on to take profit. Well, this trade here is a 1 to 4, let's say. So we have 0.5 left running and it goes on to hit 4 RR. So we have to half whatever the RR is. So we would gain another 2 RR from this position, right? So we would gain another 2% from this position. So we're actually only losing out on 0.5. Why? Because we took 1.5 earlier at 3 RR. Price then goes on to trade 4. We take 2% from that. So we walk away with 3.5% from this position. So by taking a partial for 50% at 3 RR, worst case scenario, we walk away with 1%. Best case scenario, we walk away with 3.5% on a 4 RR trade. Now that to me sounds like a very good outcome regardless of the situation. And this is something that I implement and this is something that I follow with every single position that I place. Now you may be wondering, well, Luke, what happens if price doesn't actually reach 3 RR and we have a reversal and price hits stop loss? Well, we take that loss. We take that 1% loss. But what we've got to remember is if we have a risk-to-reward ratio of a 1 to 4, 1 to 5 for every position that we are placing, the off chances of price reaching that is fairly high, assuming we have done the correct analysis. So therefore, one position like this, where we walk away with 3.5%, would actually cover us for 3.5 losses. And another thing to take away is, if we have a success rate of 50%, then 50% of our positions are going to be correct and only 50% are going to be incorrect. So by having the risk reward ratios we have on these positions down to where we place our stop loss and down to where we place our take profit almost guarantees that we are going to be successful in these forex markets. Now again, another thing that we can implement is actually trailing stop losses. So let's say that our take profit was set up here, right? Price has traded up, price has traded back down to set a higher low fractally. Price is now going on to set a higher high. So let's just say this is the structure, right? Well, this would be the last protected low, right? So then by moving our stop loss just below this low that's been set here, that guarantees that if price does reverse and trade us lower to break structure to the downside, for one, we don't want to be in the market anyway because it's broken a structural point. And secondly, we are taking home as much as we can before we have that confirmation that price is no longer following our analysis. Because as we said earlier, only in bearish structure do we break the lows. So if we are breaking this low, we can now expect price to go bearish, and that could result in us taking a loss. So by trailing our stop loss and placing it just below this last protected low, we are guaranteeing that we walk away with the max profits we can do in terms of this position. So another good thing to do is implement trailing stop losses, but they should only be placed above or below protected highs and lows, depending on the direction that we are trading in. So those are two things that I'm very, very strict on when it comes to risk management: trailing stop losses and taking partials in my position. If you want a full video on risk management where I go real in depth with these two things that I implement in terms of risk management, I do actually have a risk management video already on YouTube where I go into these topics on a deeper level. I will leave a card somewhere on screen so you can click on that if you want to watch that video. But trailing stop losses, as I say, and taking partials throughout position are two things that I would definitely recommend that you guys integrate and implement into your trading plan. So just going back to this screen, there are two more things that we can add. Perfect. So we have quite a few pointers there that I want you guys to take away with you. As I've said throughout all of these videos, if you pause the screen now, take a screenshot just so you've got it, write it down in your journal, write it down in your trading plan, have these things in place, or look to implement some of these things. Have your own spin on them if you want to, but definitely look at partialing, definitely look at trailing your stop losses. Be cautious on what you're risking for every trade that you place. That is actually going to summarize this segment of this series. So we've covered risk management there and some of the important things that we should be looking at: managing a running position, how much exposure we have in the markets for every position that we place, and where we are placing our stop loss and take profit orders. Now, I hope this video has helped. I hope you guys have taken something away from this. If you have any questions or queries, as always, leave them in the comments below. I'll be sure to get back to you as soon as possible. And if you aren't involved in our Learning Lounge group chat or our VIP services, then take a look in the description. We have links there that will take you through to our VIP services. I would highly recommend getting involved if you're someone who is wanting to profit in the markets, but also learn how to trade on a deeper level. Now, the next two topics that we're going to be going over are entry and exit criteria and trading strategy. So we've kind of touched base on those in the last two videos, this video and the last one. So what I'm going to do is with these videos, I'm going to go into detail on both criteria, but as an overall scope rather than not focusing on my strategy. So the things that you should be looking at, the things that you need to be doing in terms of your trading plan and the overview and things of that nature. And then what we'll be doing is looking at backtesting and record keeping. So stay tuned for the next video. It should be out next week. If you have enjoyed this one, don't forget to leave this video a thumbs up. All the support you guys provide is very much appreciated. Now, with all of that being said, I'll catch you all in the next video.